Hello and welcome to the Insight is Capital podcast. I'm Pierre Daly, managing editor of advisoranalyst.com. My very special guest is Kim Shannon, founder and Co-CIO of Sionna Investment Managers. Since joining the industry in 1983, Kim has won numerous awards, including Morningstar Fund Manager of the Year in 2005, the RBC Canadian Woman Entrepreneur Award in 2007, and Canada's Most Powerful Women Top 100 in both 2007 and 2017. She sits on the board of the Brandis Institute, the Ontario Arts Council, and United Corporation. Last year, Kim was among a select few to present at the Columbia Business School's From Graham to Buffett Omaha panel, and in 2019, co-hosted the female-led Variant Perspectives Value Investing Conference in 2019, featuring Warren Buffett as keynote speaker.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Kim, welcome to the show. It's really great to have you.
Terrific. Thanks. Glad to be here, Pierre.
Kim, to kick things off, before we get to talking, please tell us about your background, what inspired you to get into the business, the arc of your career, what it was like to start your own firm, and what's new. That's a lot to unpack.
To that. So let's keep going. Well, I started off in university studying anthropology, zoology. But in the meantime, I did a lot of volunteer work. And at the end of my degree, I realized it was time for a change, and had in a casual conversation with a friend, had an epiphany that this organizing thing that I love to do as running all these student organizations was business. So I went back and I did an undergrad in economics and commerce, graduated with distinction, realized I was onto something, looked for a job. It was way back in early 93, and it was an economic recession. And I was lucky enough to find a job in a really small trucking fleet insurance company, managing insurance reserves,
right,
and basically rolling T-bills. And it was, in a contrary way, one of the best jobs to get at the time, because I ended up managing equity reserves. But at that moment in time, I was rolling T-bills at 14%. Equities were trading at a 9 PE multiple. Excuse me, this was in the early 80s, not the early 90s.
Yeah.
And, if nobody in their right mind had any desire to go into equity investing. And that
this was just shortly after the death of equities, right?
Absolutely. We had this peak in interest rates, and we were constantly looking over our back for inflation to come back again. And I end up deciding I need to work in an investment department and land at Royal & Sun Alliance in the investment department, which I worked at for a decade.
Right.
And was fortunate enough to work under a very brilliant value investor called John D. Tomasso. And he was a philosophy major, and he was a cigar butt value guy. And he came at business from a very philosophical perspective. And I learned that the stock market reflects human nature as much as it does underlying fundamental values, and that human beings have a tendency to success, and that gets embedded in stock prices in multiple ways. Right. And value managers try and take advantage of that excess embedded by searching the landscape, looking for stocks trading below intrinsic value, and then patiently waiting for them to come back. So I learned at the feet of someone very good, watched it happen over several years. When he left, I got the top job and did very well. Moved to a real investment counselor to learn the trade, connected up with an old mutual fund company, Spectrum United,
right.
Managed took over one of the oldest Canadian mutual funds in Canada, the Canadian Investment Fund, dating back to 1932.
Yep.
And it was down to 40 million, which is basically you take it out into the back shed and kill it. I applied it, my techniques of value investing, with low risk, because I'd modified from John being a cigar butt value manager a bit. You reflect your own personality in the way that you invest.
Yeah.
And we improved the track record dramatically. And by the time I separated from that fund, it had become like once again the largest Canadian equity mutual fund in Canada. And along the way,
Amazing. Yeah.
back in 2002, after, I'd moved to Spectrum, I'd moved to Merrill Lynch, and then I had a chance to launch Sionna with a new holder of the mutual fund company, CI Funds. And we were had a very good relationship for 4 years until we decided to disconnect. So my assets were very variable. They grows very dramatically. And it then shrunk. So from basically 9 billion of AUM down to 900 million. So in this essence, we started all over again. And then we've been building up ever since. So that's the history of the firm overall, how I started the firm, with a major client, which made it a lot easier.
Yeah.
Carrying on. But as you can imagine, it hasn't been the best decade. It hasn't been the best 2 years for value overall. So, you're catching a value manager, on their back legs, so to speak. We've had a good move in value. It's come and gone, but it's very similar to what you saw in prior cycles of the big switch from growth back to value.
Yeah, I was going to say, I mean, it's been a very tough go for value managers in general this last decade, but touching on what you're just saying, that's historically, that's what separated the wheat from the chaff. I mean, it's having and maintaining the fortitude and the conviction to stick to your style and to stay with your convictions as a value investor, and not be tempted to stray away from your style or to drift. And many value investors have come and gone that way, have sort of caved into the pressure to change style. And so I think when everything gets ironed out in the long run, we'll see, who the purists were and who wasn't. And I think that says a lot for you in terms of being true to your philosophy of investing, which, in the very long-term sense is not really strictly value investing. It's just investing, isn't it? It's just good investing. And because I think a lot of people have been sort of perplexed over the last decade by fundamentals being completely disregarded as a reason for investing, and just focusing on momentum or just focusing on growth, but especially momentum. So having said that,
could I just jump in and add to some of that, items that you put out there? I mean, what's really interesting about the last decade, actually the last 12 years, is when you look back historically, the data comparison between value and growth goes back to 1926. The databases just aren't granular enough prior to that to be able to sketch out the details. People, you just can't get your hands on old financial statements to really disaggregate. Right. And when you get back to that time frame, you basically only have monthly data. You don't have daily trades. You certainly don't have hourly trades documented. So you're dealing with a lot of really sketchy information. And in that history of some odd 90 years, this has been the deepest and the longest period of underperformance of value. So last year I wrote a piece called Waiting for Dawn, because and we also ended it when we came out of that big correction in the spring of 2020. It was the first time in financial market history for value versus growth where value actually underperformed in a bad market. So that really affected client psyche about value, because a lot of clients had held in with value because it always defended in a down market. And this was the first time that it didn't. Now, it did come roaring back with the overall market, and value did fine ultimately. but it was very brutal. The deeper value you were, the more brutal the pain was in that time period.
Right.
So that was that really caused a big rift for value investing. But I've been in the markets since '83, and and also my mentors all lived through the '70s, and in the mid '70s, when nobody was really, you had the whole Nifty 50 phenomena, which, we'd never seen stocks in aggregate go to a 25 PE multiple before in financial market
Right.
history. That was considered insane. And then we know how that unfolded. And so value managers have been challenged in the past. There was a big, ugly period in the '30s. Then there was notably the mid 1970s. Then I got to witness the '87 crash. But that whole period leading up to that '87 crash was very brutal for value managers. And then there was, of course, 2000, which for me personally was worse than what's been happening today in a lot of ways. It was just briefer for Canadian investors. But, in the summer of 2000, underperforming the benchmark by 20%.
Mm-hmm.
It was just a brutal underperformance. And I wondered how long it would take to earn back relative outperformance. We earned back so much by the end of that year. And the next 2 years was huge relative outperformance for value. But when you look at those past challenges, it tends to come in waves. And I think a lot of people forget it. Bernstein wrote a fabulous piece about the 2000 unwinding of value and growth. And the first phase is very similar to what's happened this cycle. The first phase, the companies that earned no earnings got hit first.
Right.
Then, if you recall, in Canada, there was that painful period where Nortel had gone all the way up to $90 a share and then had corrected all the way down to 60.
Yeah.
Only over the summer in Canada, and growth peaked in March in the US. It peaked September 1 in Canada because we had the optical stocks, Nortel and JDS, and they shot to the moon all through the summer. And, we had Nortel go to $124 a share. And became 36% of the benchmark,
Yeah.
making it very hard for anyone who was trying to avoid an outrageously overpriced stock like that. So I think we're now potentially beginning the second phase of the unwinding, which is that you have legitimate tech stocks that have excessive implied growth embedded in their valuation, and implied growth rates that are unlikely to be sustained. And for me, the poster childs of that in the marketplace today, have to be Tesla and Shopify. They're both trading at extraordinary multiples. Even if you're trying to find like a forward multiple that makes it make sense,
Right.
you can maybe get them down to 150 PE multiple. And at that level, it means it's 150 years for the current earnings to pay for this stock.
Right.
So the applied growth rate is so significant. And when you look back at history, how many stocks have had phenomenal implied growth rates? And for such a long time horizon. The average tenure of the publicly listed stock today is somewhere around 20 years. And when you look back at what were the biggest stocks of 100 years ago, not many of them still exist in any significant
Absolutely.
way today. And when you look at the darlings of prior stock markets, like the 1970s and like 2000, like back in the 70s, you had stocks like that went on to do extremely well, like McDonald's and like Disney. But you made no money at all in these stocks for 15 to 20 years.
Yeah. And what was the likelihood that you stayed in an ownership position with those stocks, regardless of, the following 20 years? What are the odds that you stayed there,
in a lost position?
Exactly.
overall total return. And even when you look back at 2000, of the Bernstein report that looked at the top 9 and the top 12, only 2 of those stocks ever came back to the same market cap highs. All the rest did not. Nortel's gone. Sun Microsystems is gone. Cisco's around, not so exciting. Lucent's around. Intel's around. Nobody talks about those stocks to the same degree anymore. They're no longer exciting stocks. And you have a number of people thinking that the top stocks of today will walk on water for a very long period of time. Some might, but some probably will not. And so, value managers think, and I've seen it happen over and over again, you're safer buying good quality firms, where you understand the earnings machine capability of the firm. You look at those normalized earnings, you make, very simplistic assumptions about where it's going to go in the next couple of years. And then you try and buy those stocks with a nice fat margin of safety so that if anything goes wrong, in the fullness of time, you really should make some money on those names. And you're starting to see some opportunity once again out there in the marketplace for value. Perhaps we'll have the revenge of contrarian investors. But the full story hasn't been told. We are in the middle of it, and there's still a lot of doubt out there.
Yeah, it reminds me of the listening to you. It's reminiscent really when you look at for example, the 1966 to 81 period. Few people. I guess what I'm going to get at is that I think a lot of today's market participants are not in touch with history anymore. Of course, there are those. There's always exceptions to that. So I don't want to include I don't want to say everybody's not in touch with market history, but a lot of that perspective is being shared by a minority of people, and the majority seem to be locked in to what's going on in markets the last 10 years, the last 12, 10 or 12 years.
And that's the average age of participants.
Yeah.
Like when you think about the stock market and investing, is the average investor comes into the market, maybe they start dabbling a little bit in their 20s, but they don't have a lot of money. So it's not until you're almost 30 that you have a little bit of money. And then you start playing around and you try to learn the craft of investing. And then you start in a certain environment. I happen to start when, short-term interest rates were 14% and equity PE multiples were 9. So you're trying to learn the lessons. The lessons that were being taught back then is you look at the last boogeyman or the last excitement in the market. And the last boogeyman back in the early 80s was inflation. We spent over a decade looking for inflation to come back. We didn't believe that it had gone away. My entire CFA was all about how to operate in an inflationary environment. I finally think I might get a chance to use that knowledge.
Yeah.
It hasn't been useful to me for my whole career. So the window that you learn in, so people start investing, and typically most investors make a lot of mistakes before they decide they need to find a professional to help them. Because at the rate they're going, they're not going to have money for their retirement. And then you only get to this investment time horizon of making wealth for about 40 years, unless we change longevity for human beings. And then you have to spend the rest of your life eating or cooking. And that's why you eventually go find a professional to help you manage. And ideally, your professional helper will know a lot about the sweep of financial market history. Because I mentioned earlier, markets are equal parts rationality and human emotions. And you can't forget the other. And so the markets go to euphoric highs and depressed lows well above and well below long-term true net worth. And it behooves investors to understand that. And we have this unique environment today, as in all markets, where you have a lot of young participants who haven't been in the market that long. even the profile of professionals. When you look at the profile of the Toronto Society of Financial Analysts, which has to be a microcosm for the entire CFA organization globally,
Right.
you look at the number of participants over the age of 50, it's 10% or less of the population. So, you start doing the math and you slice down that age group. How many participants have even witnessed a bear market like '08?
Exactly.
Very
Yeah.
few. And then to actually have witnessed 2000 or 87 or you have to be of a certain age, mostly in retirement, to have remembered what it was like to operate in the 70s. So there's not a lot of participants around sharing those experiences and education. And no big surprise, the data is showing we have one of the most speculative markets out there. A lot of people playing in a very speculative way. We also have a lot of lending in terms of investing, which has always talked about the excessiveness of markets. And we have one of the most expensive markets in the world, particularly centered in the US. In financial market history, it's been rare to see a market this expensive. I saw a recent quote that said, when you add both public and private companies together, as a percentage of GDP, the number's 290 today. It was 190 in 2000 when the market blew up. This is a risky, overpriced market, particularly in the US, which is the leading market in the world. And the US market is a significant part of the global benchmark, which people are clustering into. This is a market to be careful and cautious in. And I will argue is an excellent market to begin to move more of your investing into value to protect your wealth.
Right.
And in particular, I think Canada is a more reasonably priced market in aggregate with a better yield, which is also affirming how inexpensive our market is overall. And in the aftermath of 2000, Canada was cheaper, and it outperformed the US market for 6 years solid after that. And the relative cheapness of Canada against the US compared to 2000, we are cheaper today than we were relative to the US of 2000. So there is that opportunity for the history to repeat itself.
So we're going to get to Canada. I want to ask you about that, but first, I'm just curious to know, has your value investing style evolved? And if so, how?
Yes. Excellent question, because, obviously you have to change with the times and you have to change with the data. And you also have to change with the change in accounting rules. And they've changed fairly dramatically throughout my career. And most of us would argue that right now, book value is not as compelling a ratio to look at as in the past. It may become more compelling in the future, but the movement to fair value accounting has broken down some of those signals in certain industry groups in particular. And so you've had to lean more heavily on other ratios and attributes. Again, so that has happened. The other thing is in the early part of my career, it was very hard to download information. Literally, my job early on was to call each company up and ask for their annual report.
Right.
Wait for it to arrive in the mail and record the data in our model. And we would price it once a week off a modem and turn it on overnight. And charting you did overnight on a dot matrix system. So technology has dramatically improved, and the quality of information and the overload of information. Early in my career, we sought information. We wanted to get an information advantage. Now it's about editing the voluminous information that's coming at people. So that's been a big sea change. But more information isn't always useful. And I one of the CEOs of a major corporation in the past said, you want more information, we'll give you a telephone book of information. And that's a bit of what you're getting now. It's definitely stronger and stronger cups of coffee, to read through the notes of financial statements today, they're so complicated and complex and voluminous. So you've had to adjust to all of those changes. But the core principles of value investing have still remained there. And there's still the principle of looking at aggressive accounting practices. We've always looked at governance, but today governance has been expanded to E and S.
Yeah.
And they've always been there. You always would have the risk of a liability if you invested in a company that was, not being good on E and S as well. Eventually, those liabilities will come back and bite you. So we were always focusing on quality, but the demands have certainly cranked up on that. But data makes that easier to handle those extra loads in terms of the research.
Yeah. Speaking of ESG, I what we've seen, I think from our, from our side, in terms of our audience being advisors, we've seen, I think, what we would deem to be a lot of ambivalence about ESG. And I think it goes to what you just said, which is that, a lot of people in the business feel like this is not new. Why do I have to act like it is? Right? Why do I have to identify it as something new when it's not actually new? It's something that's always been there. We've always been worried about, whether or not we should invest in tobacco stocks or fossil fuels or polluters or, Union Carbide as sort of a historical example of a company that created an incredible amount of risk for investors and losses. And, I think people, a lot of advisors maybe shrug off ESG, thinking like, what's all the fuss? What's the big deal about ESG? And really, all that's changed is that it's become more defined. It's not something that's sort of esoteric anymore, or something that you on a one-off basis consider, as you're picking stocks. But it just,
you have to keep in mind that environmental issues are probably best dealt with at a government level.
yes,
And because the government talked a big talk and didn't act very much, frustrated people thought, well, let's take another tact. And they went after publicly listed firms. And so we're bearing the brunt of the public's desire to change something that should have been handled by governments. And so that's part of why there is a certain element of frustration. This isn't probably being best dealt with at the right level. And, there's a lot of debate about, should we be forcing major corporations that by and large are, the better organizations out there have tried to be good in the major nations, good corporate citizens on environmentalism. But they're getting tarred and feathered for having some of the, some operations, let's say like coal. And so there's this whole divestment urge that's gone out there. And firms have had to sell these assets to look cleaner and better. But, who are they selling them to?
Yeah.
And that's one of the issues. And then once it's gone dark in terms of a public ability to force behavior, will they be managed in a responsible way? And one of the shocking results of this year is that the underinvestment in a lot of energy has had numerous splashdown effects, such that you're now seeing parts of Europe and Asia having to turn to coal in order to supply enough energy to run businesses and heat homes, because we relied on renewables as your staple source, and there isn't enough of them. Like, I understand one of the issues in England this year is that there wasn't enough sun in the summer and enough wind to run the turbines. And so had to rely on natural gas, and there was a lack of supply. And so, the price of energy's gone up very, very rapidly. So that's an unintended consequence of trying to move a little too fast. Renewables only represent currently 12% of the total energy picture.
Yeah.
And the world's trying rapidly to change it, but that's the reality to which we face right at the moment.
Yeah, it reminds me of the sort of the foibles of what's going on in Germany with nuclear power and coal, or nuclear power versus coal. Last decade, Germany phased out half of its nuclear reactors because of Fukushima, and because of German sort of resistance to nuclear power in general because of Chernobyl, and so in the course of doing that, they had to replace nuclear with coal. And there's this great movie, I don't know if you've seen it, this Ed Bertinsky movie called Anthropocene, and it's on Crave or HBO or one of those stations. And one of the segments details what's going on in Germany with coal excavation. And they've got these coal excavators that are the size of buildings, and they are carving up the German countryside for lignite. And in the course of doing this, they're raising villages and towns that are in the way, and the people in those villages and towns have to be relocated. And they're tearing down historical monuments, and in an effort to feed the coal machine in Germany. And so they're not able, they haven't been able to keep up with the demand for coal. And because of that, so now not only is Germany a huge emitter because of their power demands that are being fed by coal instead of nuclear, they now have to buy excess power from France's nuclear power. And so they've defeated themselves on both fronts. They're not only a larger emitter for their power demands because they tried to meet with this governance demand of closing down nuclear, but they're now buying nuclear power anyway. And so they've got this double problem of pollution and governance that they're grappling with. And it's ironic because again, it's an unintended consequence of let's say bad governance decisions or misdirected governance decisions on the ESG side in order to meet with social demands of the people. And then at the same
all well
time,
intended.
at
It's
the
all
same
well
time,
intended.
on the other side of the nuclear question is now that people are starting to re-identify nuclear as clean energy, and so the reignition or starting of new nuclear power plant properties, in particular by China's Belt and Road Initiative, is placing huge demands on the future for uranium, right? So uranium prices have skyrocketed. And so I look at that and I think it's ironic that in the course of trying to decarbonize the world and in order to try to decarbonize supply, they've been decarbonizing supply at a faster rate than decarbonizing demand. And so
There's a book written 5 years ago or so.
Yeah.
They got great reviews in business or Financial Times, for example, and it was called The Moral Case for Oil. And in a lot of ways, that book foretold the situation that we're in today. And they talked about yes, we're trying very hard on technological innovation, but if we move too fast, it increases the cost of energy, which is what we're seeing. And in a sense, we're, environmentalism today is part of this picture of what looks like growing persistent inflation, because we're seeing fuel prices around the world going up dramatically, and that spills over into so many goods and products and services. and it's forcing prices up. And that's why I think we're starting to see the word transient getting removed from this whole inflation argument overall. And we're also seeing now, fairly persistent movements in wage inflation. And in particular, I'm finding it interesting. I'd say it was about a month ago, John Deere and Company, I understand their union turned down a 10% wage hike. So, we have not had unions have a lot of power and push back against business in several decades. So the world seems to be
starting to
changing
happen though, right?
fast. Yeah.
Just,
And
I think
this is part of that whole, I think
labor.
business world is, it's this major ecosystem. And when you move one element of that ecosystem, it has impacts all over that ecosystem.
Labor is starting to get a foothold. And I mean, yesterday there was the news about the Starbucks, the Starbucks outlet that unionized. I can't remember where it was. It was in somewhere in
Detroit or
yeah,
Buffalo,
Buffalo, Western New York. Yeah. So like, wow, where did that come from? Unionizing a store. I mean, that's where it starts. Obviously, is unionizing a store. Next thing is unionizing the whole state, and then a movement gets started. And but the labor movement, I think, is slated for a comeback. And so, and those are the sticky parts of inflation, right? I mean, those are the aspects of inflation that you can't do away with or go back to, revert back to the mean. You can't put people back on a lower wage after you've given them a higher one. And
well, we haven't had wage pressure to any significant degree for quite some time. And that was, I think, part of why people were willing to accept that inflation was transient. But now that you're seeing difficulty filling positions, you're seeing a lot of movement of labor at all levels. And employers are starting to realize that it's very difficult to replace your best employees if they leave. And so they're willing to give them, offer them more money, more incentives to stay with the employer. And that is really creating that push on inflation, which is ultimately, it's another element of adding to that inflationary story. And it's coming in a sense, almost just in time. You were trying to talk a bit about the sweeps of history when you were talking about the 66 to 81 time period.
Yeah.
Because that was the sideways market in equities. But, 81 symbolic. We had interest rates peak in 1981. So the last deflationary low in interest rates was in 1941. And the U.S. fell to what was considered then an all-time record low interest rate of 1.95%. That sounds almost great today. And then it had a long, low U. And it went sideways for a lengthy period of time. And then it slowly started increasing. And then we eventually had runaway inflation leading into 1981, where it peaked. And Reagan and Volcker broke the back of inflation expectations by ramming rates very, very high, and was successful. And rates started to come down. And we have been in a deflationary. So that was a 40-year upcycle for rates. And then now we've just arguably completed a 40-year cycle down. In fact, it ended up being a little less than 40 years. And if you look back in history, rate cycles tend to be roughly 20 years. 20 years, they kind of go up, and then 20 years, they kind of go down. And if you look back in history, except for this extremely lengthy period from 41 to 81. And you tend to find that these cycles are somewhat symmetrical. But Jeremy Grantham has talked about when you get 3 standard deviation events, when something's really off the charts. He said, when you have this, incredible, he talked about this a lot in the 2000 period, you have something go up dramatically,
Yeah.
And he did it, for markets, for segments of the markets, for commodities, any kind of investable asset.
Yeah.
He
Their
did it
analysis is
for it.
amazing.
If it went up, it came back down pretty much to where it began. But
Yeah.
he said it often comes back down a little shorter. So, a few months shorter.
Yeah.
So I would argue that probably the low in rates, if history repeats itself, and time will tell the answer to this, it was probably the spring of 2020. Because we had, because of COVID shock, a synchronous drop in rates to new lows. And synchronous is symbolic in a lot of ways in my mind. And so we had this drop in rates to new lows, and we've had it rise since then, in a, stepwise fashion, but we're up off those lows. So, and now we seem to have inflation that's no longer transient, but potentially permanent. So are we now finally in that paradigm pricing shift of rising interest rates? And, looking back at history, it seems probable. Now, you can argue that that's not correct because Japan is in a different cycle, and its drop in rates has lasted even longer. So is that our guide, or is history our guide?
Yeah, I mean, the Japan example is a wonderful sort of history lesson, isn't it? I mean, in terms of looking at, the fact that Japan has never recovered back to its 89 high. It reminds me, like, I just to change gears a little bit, because I'm just curious to know, like, we're now talking about these two 40-year trends, 41 to 81 and 82 to 22. And do you think that this deflationary cycle that we've been in, this long 40-year deflationary or disinflationary cycle that we've been in, with rates falling from historical highs to 5,000-year lows, do you think that, is it possible that the rise of passive investing has corresponded along with it in terms of the rise and the adoption from 81, beginning with passive investing in the early days to what is now this passive behemoth? And the reason I'm asking that is that Mike Green from Simplify has really has come out in the last year and a half or so with what's now called the inelastic market hypothesis, and it runs counter to the FAMA efficient market hypothesis. So it's the contra argument, and in it the argument is that the shift from historically active management to the present of passive indexing, passive investing, has created a substantial inelasticity in the market.
Uh-huh.
Right?
Well, I haven't read his material, but it sounds pretty fascinating. I mean, the history of passive investing, it starts in the 60s with the development of the efficient market hypothesis, because you had to start with that belief that the market, incorporates all known information into the market rapidly and instantly and gets priced in. Now this reminds me.
The theory, Kim, is that the efficient market hypothesis, which led to passive investing, has caused the market to become inelastic.
Yeah, no, I get the point.
Sorry. Yeah. No, I was just, I wasn't.
But it's there's an element of, throughout human history, philosophers have always tried to forecast human behavior. And it's impossible to do because humans are essentially irrational. And so when you look at philosophers trying to forecast human behavior, and now economists or, financial, academics trying to forecast human behavior, they have to make some assumptions to come up with their theories. And the first assumptions they always make is assuming humans are rational, which we know is not true.
Yeah.
And so that's the first step. So what's wrong with the efficient market hypothesis? Does the market instantly price all known information into a stock immediately? Is there no obstacles to true net worth being priced into stocks immediately? Well, examples like the 87 stock market crash are good examples of that, because
Right.
we had a market that declined very rapidly in a day and then bounced back pretty rapidly too. Did the values really drop 25% in a day, or was it too high one day and too low the next? So, I don't, so I'm, most of all value managers by belief, in value do not agree with the efficient market hypothesis. Right. We're all contrarian investors. We do not believe that every single stock in the marketplace is efficiently priced. Now, when you move to passive investing, so that gets written. And by 1971, you had a random walk down Wall Street written, which supposed that what if you were able to buy an index cheaply, instead of paying expensive active manager fees, if you were able to just buy the index, wouldn't that be cool? You could get the free rider effect of, free rider common law. You could ride off the backs of, there's enough institutional investors more or less making the market efficient that you could now free ride on what they've done to the market and not pay them and get the benefits of an efficient market. So the great experiment that we're doing today is, when are we at the point that there's so much passive management going on in the marketplace overall that the market might not be efficiently priced any longer?
Right.
And we don't know that until we hit it. And that's,
exactly.
And when you look at markets, we rely so heavily now on benchmarking and benchmark indexes. And we've collectively decided that the best benchmarks are cap-weighted benchmarks, but they do have flaws. And they're based on the most liquid names in the market. And Robert Arnault, in his book, Fundamental Indexing, he built his firm largely off the theory of fundamental indexing, is that cap-weighted benchmarks are essentially, somewhat inefficient. And that if you reweight the benchmark in any rational way, because, cap weighting captures the popularity contest in a market. Right. Like, everybody loves Tesla. They're paying a crazy price. Tesla represents a very large percentage of the benchmark. And therefore, if Tesla comes back down to earth, that benchmark's going to get hit really hard. And then when you expand that to people falling in love with global benchmarks, right now, the U.S. is, I believe, around 60% of the global benchmark. It was as high, I believe, as 70%. No market in the world has ever represented that high a weight in the benchmark. And the only one that did, you mentioned earlier, Japan. Yeah. Japan, back in 1989, was 44% of the global benchmark, was just crazy on weight.
The U.S. is currently a third, right?
And right now, what weight in the global benchmark is Japan? I believe the last time I looked, it's 6.5%. Yeah. So we're all believing that the U.S. must and should represent 60% of the global benchmark because of this cap mark weighting. And what you're mentioning is right now today, there's different ways of slicing a benchmark. And one rational way might be, what's the GDP? And GDP for the U.S. would be 25%. For China would be 25%. China is a very small weight of the global benchmark because of this cap benchmark weighting. So maybe the better number for the U.S. is somewhere between 25 and 60, but where? And, right. And we also know that after a market has become too expensive in a global benchmark, its weight can fall back down to earth. And Japan, in a capitalization only basis, is still below its prior higher of 89. Right. And interestingly enough, I don't know about other markets, but right now, London is still below its 2000 high. So when markets get overpriced, it takes a long time for investors to get their wealth back. And so passive investing, or this enormous focus on global benchmarks, could end up being a challenge for investors going forward in the future.
Yeah, and I guess the observation is that this very substantial segment of market participants is locked into this idea of just buy the index, just keep buying it, and as long as that sort of juggernaut of buying is going on, whether it's 401ks in the U.S. that are buying the market every 2 weeks, there's just that. I think what looks very worrisome is the fact that every single one of those names, whether it's Apple or Tesla or they're just being bought indiscriminately and being valued higher indiscriminately, as long as the buying is going on. But as soon as the tide reverses for any reason, there's very little support for those prices on the reversal.
Yeah. And when you look back in history, and you can go back and look at
and conversely, there's more support for the lower cap value names in the market because of structural support in the market. The market makers have more support for the 10, 20, 30 billion cap companies than they do for the 3 trillion cap Apple, because they simply can't support the market for Apple versus the way they can support the market for a lower cap name.
Well, what ends up happening is almost every active manager, to a greater or lesser degree, is a risk manager and will take some risk off the table in a hot, frothy, speculative market. And it happened in the past. And so what you see is, when that market collapses, the value managers tend to do well and the active managers tend to start to outperform. So you actually have data going back in history looking at active managers when they outperform the benchmark and when they underperform. And at a very hot, frothy, expensive market, active managers as a group underperform. And so people comment on that. Look at how few active managers are outperforming this benchmark. Therefore, you should be in passive investing. But this is, arguably in a lot of ways, not the time to be owning, this expensive market in an index way, that by being with active managers who are managing risk more, are likely to be more defensive on the way down. And that's what history suggests and what, rationality suggests as well.
Yeah, and that's assuming rationality comes back to, reverts back to the mean, a little higher.
That the market is actually rational to some degree.
Exactly.
But right now we value managers are going to argue the market's very irrational at the moment. And when it comes back down a little bit, it'll be more rational.
Absolutely. So Kim, before we run out of time, because I do want to give it the time that it deserves, let's talk about Canada. All right. You've been talking a lot about Canada. We've talked about inflation today. We've talked about we've talked about the market dynamics of inflation. We've talked about the fact that reflation is a value trade. I think we've laid a pretty good groundwork to talk about why Canada is really attractive today.
Well, Canada is trading at a much lower multiple. The U.S. overall is trading at a 21 PE multiple. And historically, we've got good database going back to 1870. And whenever you've had the market trading north of a 21 PE multiple, the Shiller PE multiple will suggest that over the next decade, your average return to investing should be 1%. Now, there's a swath of what has happened in the past, and it's been as juicy as an 8.5% annualized return over 10 years to a negative 6% annualized 10-year return to investing with an average of 1. in the aftermath of 2000, the market was above a 21 PE multiple. 10 years later, in 2010, the average return ended up being right on that financial market history data set, right on 1% total return. So, but did anyone buying in 2000 expect that their annualized return would be a mere 1%?
Right.
No. You know, when you think of the median, the amount of money that's thrown into the market back then as it is happening today. And that's where we are sitting in the marketplace today. And that's the US. And meanwhile, we have Canada trading at 15.
Wow.
You know, where our market is fairly priced. It's priced at financial market history. Now, underneath the surface, Canada, again, like in 2000, is fairly bifurcated. We've got a very expensive Shopify and some other stocks in our market.
Right.
But right now, as at November, we have 70% of Canadian stocks are trading 10% below their 52-week highs. And 41% of Canadian stocks are trading 20% below their 52-week highs. And if you had the market overall trading 20% below your prior period, you know, like that is that's a bear market. But what's TSX doing over the last year? It's up 21%. That is, now if you look at history, and Dimson, Marsh and Stoughton did the global benchmark survey of all major markets in the world going back 118 years. And they've shown that the average expected return to investing in Canada is 7%. Now, to put that into context, the world index is 6.5%. US has tended to be a little bit richer than Canada, but Canada is a little bit richer than the global benchmark overall in aggregate. And so we're not a bad one. We're actually a pretty decent returning market. So 21% return over the last year is 3 times the historical average. That's a really amazing return for the market overall. So, and now I've lost my train of thought.
But the index, the index, Kim, is really acting as a curtain for what's really going on underneath the index, right? Like I've been hearing from different commentaries that we've actually been in a bear market of sorts since February. And it's only these market leaders that are driving the entire market higher. So if you just follow the indices, you're getting the illusion that we're in this raging bull market. But in reality, there's this entire layer, of the market that's already been in a bear market from as far back as February, since the turn in the market in February, and since the turn in the economy in February. And so, I guess the point I'll make there is that given that the markets are actually in a bear market, in terms of the layer that we're talking about, beyond the top 10 or 20 names, that actually bodes extremely well for forward expected returns. Right?
Yes.
And then
in the context of, if you
not of the indices, not of the index, but of the individual names.
And you're now seeing that the earnings growth expectations for value stocks are looking much better than the expected returns for growth stocks overall. But I think that it's very difficult to market time the market consistently well. At the extremes, maybe it's a little easier to do, but that's a debatable point too. But if you want to stay fully invested, it behooves investors, and we know that investors have moved away from domestic investing globally. That has been a worldwide trend. Yeah. Canada is no different, where we're hearing that the largest Canadian pension funds in Canada have a weighting and an allocation to Canada of a mere 4% these days. And they're basically moved to the cap-weighted global benchmark weight for Canada overall. And so this shrinking of interest in our domestic market also, I believe, has created this incredibly cheap market relative to a lot of other markets in the world. Now, European markets are fairly reasonable as well, but Canada's that much cheaper than them as well. And so on a PE multiple basis, we're 15. We have a richer dividend yield than most. We actually have a dividend yield that's far superior to our 10-year government bond yield.
Yeah.
So a lot of reasons to be embedded in Canadian equities. And now we also have an exposure to commodities. And there's some factors out there showing that when inflation is north of 4%, which it is today, that Canada tends to outperform the US market. And we also see Canada so significantly cheap relative to the US. Historically, Canada then tends to outperform. So people have been not that excited about Canada because you tend to look at what the most recent past has held. And Canada has been fairly weak in the world scene. But now we're so cheap, it's our turn. This is the contrarian investments. It's a bit like buying energy last spring at minus $35 a barrel. Right. It was almost a signal. This has gotten so low, there's an opportunity here. And we now know what's happened over the next year. That we're at such a cheap level for the Canadian market overall. Is it potentially the time for this market to move ahead of other major markets and start to outperform? We've had good returns year to date in Canada relative to a lot of major markets. Speaking to your argument earlier that it's already happening. And like I've mentioned earlier, I think we've gone through the first phase of value investing. Bernstein identified 3 phases back in 2000. And, I think we're about to, hopefully in a reasonable time period, it's very hard to forecast the turns in markets, but, that are we about to enter that second phase of value investing? And just to tie in that whole inflation argument, Professor Athanassakopoulos, here in Canada at the Ben Graham School of Business, he did a study with a colleague going back to 1930, and he put it out when inflation is above 2.5%, that value outperforms growth by 11%.
Wow!
And so he
do you have the
charts.
Do you have the paper, Kim?
Yeah, and he actually wrote it up in the Globe and Mail. I'm happy to send it to you. Yeah.
Yeah, I'd love to add it to the show notes.
Yes.
That brings us to really the big one very big question, which is, do you want to passively own all of the market risk or actively manage the market risk? And, like when you're looking at Canada, I mean, our economy is very narrowly divided into a few sectors. And, it just strikes me that financials ought to do substantially better in a period going forward, as would commodities and energy. Do you have any particular segments or names that you like, Canadian names that you like right now that are sort of, glaring opportunities as far as you're concerned?
Yeah, of course. And by the way, I've taken my stand on active versus passive because I run an active management shop. So I've decided to stay in business. So as some of the points when you're at the greatest moment of pessimism, it's actually the greatest moment for opportunity. There's an opportunity for massive change. And so I've made my decision on that already. But I think there's some really interesting segments in the Canadian marketplace because of valuation. And you've talked about some of the larger segments in the Canadian market. But I don't think Canada is a distorted market. A lot of people try and say that we're too overweight in a few sectors. But if you look around the whole world, there is no perfect market that has 10% weighting in every single segment of the market. Ricardo's law of comparative advantage from 200 years ago states, If you're uneconomic at making something, stop making it and import. And what you are economic at making, make a lot of it and export it. And you're wealthier and the world's wealthier. So there's benefits to concentrating. And every market in the world has some level of concentration. Even the US market typically is 60% weighted in the top 3 sectors.
Right.
Canada is a little more concentrated than most, but not significantly so. But the areas of opportunity we see in the marketplace right now is in the energy space, but we manage risk. So we're not going to take too huge a bet there. And we're going to focus in on the quality names. The financial services sector still, pipelines within the energy space look extremely attractive as well. And then smatterings throughout the other, there's always stocks out there that are attractive overall. So like the examples of great opportunities in the marketplace would be, let's say, a Manulife.
Right.
Manulife's trading at a 7 PE multiple. It's almost a 5% dividend yield. It's overcapitalized to the tune of arguably $7 billion. It has a greater growth profile because it has a big exposure to Asia. I think people have always been a little worried about that. And they've been worried about the history of Manulife because it had problems with its annuity business. It's been shrinking that annuity business. It's been selling that annuity business. And that company has been under enormous scrutiny from their board of directors for over a decade for the challenges they faced in 2008. And so I think it's a better business than it was before. And it's very inexpensive today. But, you can also look at almost any Canadian bank, and, certainly we have our favorites, but in aggregate, the Canadian banks are trading at 11, 12 PE multiples. They have dividend yields in the high 3s into the 4s. They're overcapitalized. They were limited in increasing their dividends and doing buybacks. They're creeping back into it now that prevention has been pulled off. They have excess capital of significant amounts across the franchise. They're so well capitalized. They're so much better capitalized, better managed than they were in 2008. The risks have really started, are not as apparent as they were back then. They should be able to weather any storms that are, out there in a fairly comprehensive way. So they look attractive. But underneath that, like asset managers in aggregate are still cheap. So there's a lot of opportunity in that space. I think the pipelines, they're trading at 6 dividend yields. They have contracted businesses, not a lot of commodity price exposure. But yet they've been priced as if they have a lot of commodity price exposure. Right. And, because of this long-term contracted business, they're very, very stable. I think that they're very inexpensive, and selected energy stocks in Canada are very reasonably priced. And I think part of it is this whole divestment issue. It's put this big pressure. Historically, Canadian energy stocks trade at a premium multiple to U.S. stocks. Today, they're trading at a discount. And so, they're really inexpensive relative to history, even today. And certainly compared to the commodity price that's out there at the moment. And so there's an opportunity still today for contrarian trade in that space overall. So those are kind of the highlights that I would say are very attractive in the Canadian space. And I also think that we think that selectively some of what we call the value tech, the ones with real earnings in the software space, don't have crazy multiples at all, and yet have had a true and visible earnings growth over a long period of time. And they are inexpensive in a lot of cases today. So,
are you talking
lots
about
of opportunities.
Companies like Constellation Brands, or?
We quite like Open Text at the moment.
Open Text, okay.
Yeah.
And
it's been off a little bit, and so it's creating a real opportunity for investors. Its PE is like 14, Its debt burden is, 0.9. It's, acceptable. It's a real business. It's possible to come up with normalized earnings in a business like this.
Yeah. Yeah. There's also, outside of financials and commodities, there is this other segment of Canadian companies that have been very good at aggregating. For example, Couche-Tard.
That's
And
another stock. Wait, that's
yeah,
a reasonably priced stock in Canada today. And may well be a little bit misunderstood because people are aware that it's connected to gas stations through
right.
the ownership of convenience stores, and they're globally orientated. And I think what we tend to get in history is that when people get excited about a trend, they tend to sort of want to bring the future in a lot faster than it's likely to emerge. And so people, right now I think there's 4 million electric vehicle sales against 70 million sales of
Right.
ICE engines and internal combustion engines. And that's changing, and it's changing very fast. But when you look at a place like Norway, where Couche-Tard operates as well, 70% of all new car sales are electric
Yeah.
vehicles. And yet when you look at the sales of oil in Norway, it hasn't changed. Because there's still such an amount of existing vehicles out there demanding oil. And so that's what it's ahead of us, and people still need gas stations, but they've gone one step further. They also have, they can fill up your car to 80% capacity on electric in 20 minutes. So they're
Right.
making the convenience store very pleasant. You go in, you do a little bit of shopping, have a nice cappuccino, rest your legs on that long journey, and then get back into your vehicle, and you've had a lovely experience. And apparently, like something like 65% of the sales at Couche-Tard are people coming to the convenience store.
Yeah.
They didn't even buy gasoline. They're there to buy their
Just
lottery
shopping.
ticket.
Yeah.
They want their cigarettes. They want a cup of coffee. And this just happens to be so conveniently located. This is a business model that will survive. It has some of the best locations around the world. It's incredibly well managed. And because people top of their mind say gas stations, we don't need
Yeah.
those convenience stores in the future. We're going to need them for a long time in the future, and we'll still need them with the new vehicles.
Yeah. And they're not thinking stealthy brick and mortar retailer, right? It's the same thing here, right? We have Circle K. That's all, and then of course, historically, I always remember, Max Milk, right? That was the big retailer when I was a kid, right? That was the big convenience store retailer. But,
Right.
when you stop in for gas at a Circle K, base station, Esso, there's all kinds of things you can stop in and buy when you're there. It's not just a gas station and cigarettes. There's goods, there's snacks, there's drinks, there's there's usually like an A&W or something attached to it, and so it's like an all-in-one convenient stop to if you're hungry or anything. So it's really an amazing business model when you add it up, and when you look at the added convenience now of being able to plug your EV in at the station while you get a coffee. It's brilliant, but it's something I find that's the innovativeness and creativity of Canadians, because it's being done by Couche-Tard, but it's being done by other companies as well here. We're really good at taking something that already exists and making it better.
Yeah.
And adding creativity and innovation to run it better. And the fact that a Canadian company is all over the world. I was blown away by the attempt to acquire Carrefour, which being the largest French retailer, was mind-blowing that a Canadian company was in the market to acquire the biggest retailer in France. It's just, it just makes you proud. You just,
But it also created an enormous opportunity because a lot of people weren't happy with them doing that change in strategy.
Well, because it was like a diversion from their core.
But it was one way of getting a lot of convenience stores around the world very cheaply. But that stock price came down dramatically, if you recall, at that time. Yeah. And that we actually added more to our position because it was so inexpensive. And of course, that came back after the deal was not consummated. The French government wouldn't let them.
Yeah, they took sort of an antitrust stance against it, right?
Yes.
They didn't want a foreigner owning one of their biggest enterprises.
That's right.
So.
But they're very cost conscious, and it was a very inexpensive way of buying gas stations. And they could try their hand at some retailing, or they could let it go. They could have spun that part off.
Yeah, that was what they were afraid of in France, I guess, which is once they acquire this, what are they going to do with it? Are they going to take it apart? Right? They're always afraid of North American corporate raiders coming along and undoing their social fabric. So Kim, this has been an amazing conversation. I want to thank you very much for your time and your incredibly valuable insight. And I'm excited for the opportunities that we've talked about today. I think it's, I feel like Canada is, because we've talked about Canada, I feel like, this really is the greatest country in the world. I think this is for so many reasons, but I think this is a country where so many people want to come and live here. And so, when I contemplate the immigration drive that's happening in this country, and the amount of capital that's flowing to Canada, it's hard not to be very optimistic in the near term, but also the long term for what the future holds for Canada as well. Thank you so much, and I hope we'll have you again, and next year we'll be talking with you about getting an update from you about what's going on and what you see coming. Mm-hmm. But Kim, once again, thank you. It's been an honor, and it's been great to have you.
Thank you. It was great questions. It was a lot of fun. I'd love to do it again.
Thank you. Sorry. Look forward to it.